My name is Nur Afiqah binti Abdul Rali with number matric 300526.
Hello everyone, let's go over the current ratios for 2024 which show how well these companies handle their short-term obligations. Inery leads with the current ratio of 6.72, showing excellent liquidity and efficient resource. Panasonic follows at 5.15, proving to be financially stable and well prepared. Meanwhile, for Samsung, 2.55 strikes a moderate balance between its assets and liabilities, maintaining decent flexibility. However, YTL at 1.82 and Panasonic at 1.52 show tight liquidity, indicating challenges in covering short-term liabilities. In summary, Inery demonstrates the best financial health, while YTL and Panasonic may need to strengthen their liquidity positions. Let's look at the net working capital for 2024. At the top is Inery with a value of 0.70. This shows the company has a strong financial position with enough resources to manage its short-term obligations smoothly. Panasonic follows with a value of 0.57. This indicates solid financial health and stable operations supported by better liquidity. Samsung has a net working capital of 0.27, showing slightly lower liquidity. However, it still maintains a healthy balance to meet its needs. On the lower end, Panasonic stands at 0.19, suggesting limited resources, which could create some financial pressure. Lastly, YTL has the lowest score at 0.11, reflecting tight liquidity and challenges in managing short-term obligations. Overall, Inery leads with excellent financial flexibility, while YTL and Panasonic face greater challenges in maintaining financial stability.
Good morning everyone, my name is Teo Yin Sing, my metric number is 298170. Today, I will briefly discuss the total debt ratio comparison for the five companies in 2024. Starting with YTL, it has the highest debt ratio at 3.4%, indicating a strong reliance on debt to finance its assets, which could mean aggressive growth strategy, but also higher financial risk. On the other hand, Panasonic and Inery show the lowest debt ratio at 1.16 and 1.15, respectively, reflecting more conservative financial practice and greater reliance on equity, which ensure better financial stability. Panasonic with a ratio of 1.84 and Samsung at 1.27 are in the middle, demonstrating balanced use of debt and equity. In summary, companies like Panasonic and Inery are safer for risk-averse stakeholders, while YTL higher ratio might appeal to investors seeking growth opportunity despite its higher risk. Thank you. Next, let's take a quick look at the equity multiplier comparison for 2024. The equity multiplier is an important indicator of a company's financial leverage. Among the companies analyzed, Inery has the higher equity multiplier at 7.36, indicating a strong reliance on debt financing relative to equity. Panasonic, with an equity multiplier of 5.18, also demonstrates significant leverage, but not as high as Inery. Samsung strikes a more balanced position with a multiplier of 2.82, reflecting moderate financial leverage on the lower end. YTL at 1.67 and Panasonic at 1.47 show the risk reliant on debt, indicating leaner operation and higher equity utilization. In summary, while higher equity multiplier like those of Inery and Panasonic suggest aggressive financial strategy, they come with greater risk. Lower multiplier, as seen is YTL and Panasonic, reflect a more conservative and stable approach. Thank you.
Good morning, doctor. My name is Chu Kani. My metric number is 299611.
The 2024 net working capital turnover percentages reflect how efficiently each company uses its working capital to generate revenue. Panasonic leads with 5.89%, showing the most efficient use, followed by YTL Power at 3.05%, indicating steady performance. Panasonic Malaysia 1.67% and Inari 0.76% have lower turnovers, possibly due to a smaller operations or cautious strategies. Samsung has the lowest at 0.57%, likely due to a much larger working capital base. These figures highlight the varying efficiency levels of each company in managing their working capital. The 2024 total assets turnover ratios reflect how effectively each company uses its assets to generate revenue. Panasonic ranked highest at the 1.14%, showing strong asset utilizations, followed by Panasonic Malaysia at 0.96%, Inari 0.53%, and YTL Power 0.33%, demonstrate moderate efficiency, while Samsung has the lowest ratio at 0.15%, likely due to its much larger asset base. This result emphasizes the differences in asset efficiency among the companies.
My name is Wai Shu Yi. Matrix number is 299221. For return on asset in 2024, the highest return on asset is Panasonic at 0.15, indicates a higher return in asset compared to others. Panasonic generates profits from asset demonstrate effective resource utilization. Besides that, Samsung has the lowest return on asset at 0.014. This is because Samsung investing heavily in research and development and new technology may delay returns, lowering ROA temporarily. Next is about return on equity in 2024. The highest return on equity is Panasonic and YTL Power International Berhad, with the same ratio is 0.17. It indicates that Panasonic and YTL has high financial leverage. Besides that, Samsung has the lowest return on equity at 0.018. This is because Samsung avoids using debt relies solely on equity, which reduces return on equity. That's all for me. Thank you.
Hi, my name is Artana and my metric number is 299784.
Now let's look at the PEG ratio, which adjusts the PE ratio by considering a company's expected earnings growth. A PEG ratio below 1 usually means the stock is undervalued, while above 1 suggests overvaluation. Panasonic has a very low PEG of 0.04, indicating it may be undervalued compared to its expected growth, offering a chance for value investors if its earnings improve. YTL also has a low PEG of 0.10, suggesting it's undervalued with potential for good returns. However, Inari shows a negative PEG of 0.05, which signals negative earning growth expectation and suggests the company may be facing challenges, so caution is advised. Panasonic Malaysia with a PEG of 1.43 suggests the stock might be overvalued as investors may be overestimating its future growth, making it riskier at its current price. Finally, Samsung has a PEG of 0.14, which is low despite its high PE, meaning its growth prospects are reasonably priced, making it a good option for investors looking for growth at a fair value. In summary, Panasonic, YTL, and Samsung seem undervalued or fairly valued, while Panasonic might be overpriced and Inari faces potential challenges.
Now we are looking at the price-earnings ratios of 5 companies to understand what the market expects from them. First, we have Panasonic Malaysia, which has an extremely low PE ratio of 0.22, which may mean the company is undervalued or facing doubts about its earnings. This could be an opportunity for value investors if its earnings improve. Similarly, Inari has a low PE of 0.38, suggesting it might also be undervalued or struggling, but could bounce back if earnings rise. Next, YTL has a PE ratio of 6.83, which is low compared to most companies. This could mean it's undervalued or has modest growth expectations, making it appealing for value investors. Panasonic Malaysia, with a PE ratio of 11.44, shows stable growth potential. This could be a safe choice for conservative investors seeking steady returns. Finally, Samsung has a high PE ratio of 46.78, indicating the market expects strong growth but also carries higher risk if those expectations aren't met. In summary, the PE ratio shows a mix of low, moderate, and high growth expectations. Investors can choose based on whether they are looking for value, stability, or growth.